Hey everyone, welcome to Sujanto Real Estate. Today's topic is an important one. It's about mortgages. So mortgages are pretty much the loan that you get from a bank in order to purchase a house. Mortgages, they're really important because the majority of us, we can't buy a house cash. You need to be a millionaire for that. So instead, we have to finance it through a bank or a private lender. But the sticking point comes, how do I get approved for a mortgage? What do they look for? Can I get approved for a mortgage too? And the answer to that question is yes. Yes, you can get approved for a mortgage. Maybe not everyone can get approved for a mortgage right away, but just because you can't get approved today doesn't mean you can't get approved tomorrow. It's really important to know the three things that banks and lenders look for in your application on whether or not they decide to approve or disapprove your application. This way, you know which areas you need to improve on or which areas you can scale back. So in the future, you can get approved for a mortgage or you can get approved for a higher amount. First thing that they look for is your savings, specifically the down payment amount. The down payment is pretty much security for the bank that gives them reassurance that you will not default and you will continue to pay your mortgage payments because you are putting in your own money into the house and it's not all borrowed. A common misconception is that the minimum down payment in Ontario is 5%. This is actually not correct for all houses. It's actually only correct for homes that are under $500,000. So under $500,000, the minimum down payment is 5%. If the house is in between 500,000 to 1 million, then the first 500,000 is 5%. And then anything above 500,000 to a max of $1 million is 10% of that amount. And anything over $1 million is 20%. I know a lot of people in my age group and a lot of my friends think about investing in properties in order to rent out and build equity on those homes. So an investment property, the minimum down payment is actually 20%. This is because it is not your primary residence. So a simple example of this would be if you buy a property, you don't live there, you rent out all the rooms, then it'll be 20%. But if you lived in one of the rooms and you rented out the rest of the house to help pay for your mortgage and your rent, then you can use the minimum down payment of 5 or 10%. So it's really important to know what type of property you want and to make sure that you have that down payment in your bank account, because if you don't, then the banks will not approve your application. The thing that they look for is your credit score. So your credit rating, it's really important. It's really important to build it up since you're younger by having a credit card, having a line of credit, and as soon as you purchase something that you pay it off right away so it looks good on your credit. A big tip that I have for you is that if you have a credit card, you should either keep your credit card below 50% of its limit or below $2,500, whichever one is lower. Anything over that really hurts your credit score. Banks, they actually have a benchmark of what they look for in your credit score. They look for a credit score of at least 680 and you'll get approved. The higher your credit score, the better deal you'll get. That means better interest rates, better terms, better conditions. And if you have a credit score below 680, it is still possible to get approved for a mortgage. Between 600 to 680, you can still get approved, but it depends on the rest of your application. So it might require a higher down payment or a better debt to service ratio, which we will talk about later into the video. Anything below 600, so 300 to 600, it is still possible, but you will probably get it from a B-rated lender at a way higher interest rates. And at this point, I would highly recommend you do not take that mortgage. You should just be patient, take your time, help improve your credit score. That way you'll get a better deal later in the future at a lower interest rate. You'll be paying the lenders less money, and that's what I would personally recommend. The third thing that they look for is your total debt service ratio. This is pretty simple. It just looks at two things. One, your gross income, and two, your monthly expenses. So you have to remember this is your gross income. So this is before tax, before deductions like CPP, EI. So technically, on paper, you're making more than you actually do because of all these deductions. So when you do the calculations yourself at home, I would highly recommend you use your net income, because you don't want to run into a situation where you overestimate your income and you don't have enough money to pay off all your expenses. And monthly debt, that's fairly simple. It is all the payments that you have to make. So if you have any car payments, insurance, phone bills, and they also take 3% of your total credit debt. So that counts as line of credit, student loans, credit card debt. So they take 3% of that and they assume that you pay 3% as a monthly payment to reduce it. Now the calculation is pretty simple for this. You just take your monthly expenses and you divided it by your gross income. And that gives you a number of how much percentage of your income it takes to pay off all your expenses. And there's actually a legal limit of how high it can be when a mortgage is to be approved. So the legal limit is 42%. That means your total expenses cannot equal more than 42% of your gross income. This is the hard part for a majority of clients that I see. Unfortunately, people's total debt service ratios are too high. That means that they are too close to the 42% benchmark. This means that either their income is too low relative to their debt, or their debt is too high relative to their income, which they're pretty much the same thing. People usually see this as a really large roadblock in their process of buying a house to lower their total debt service ratio in order to get a higher loan amount so they could buy a more expensive property. And this is possible. Well, obviously, you either need to reduce your expenses or increase your income. And yeah, I know what you're thinking. This is a lot easier said than done. What I would personally recommend is that if you have free time, that you shouldn't waste it. You should learn something new, maybe learn a new skill, get a new hobby. That way you can maybe have a side gig that can earn you extra income, new knowledge that will help you advance in your career, or maybe you can even change career paths that will have a higher pay associated with it. An example of this that I usually share with people, because it's very inspiring, was a family friend of mine. Pretty much, she's a mother. She works a 9-to-5 job, and besides working all day long and taking care of her kids, she took the time to learn new things. She wanted to sell insurance, so she got licensed for that. And the extra income that she made allowed her to save enough money for a down payment. The extra income helped pay off her debt. So the increased debt and lower expenses help lower her total debt service ratio so she could be approved for more. And her whole life, she only rented. And her family did not think it was possible to ever purchase a house. But because of this decision that she made to pick up a new skill and learn to do something on the side, she was able to do just that. She was able to buy her dream house. So as long as you know the 3 things that mortgage lenders look for when approving your application, which is 1, the down payment amount, 2, your credit score, and 3, your total debt service ratio, you could reflect on your own situation, see where you can improve, areas you can scale back in order for you to finally get approved. Just because you can't get approved today doesn't mean you can't get approved tomorrow. If you have any more questions or inquiries, you can just comment down below, or feel free to send me a text or a DM on Facebook or Instagram. Thank you so much for watching my video. Please subscribe and like.